Secrets to Abundant Living podcast community. Welcome to another episode of the podcast. I am your host, Amy Sylvis. And for those of you who don't know me, I am the CEO of Sylvis Capital, where we connect investors to hands-off real estate investment opportunities. On today's episode, we would typically be going solo, but we invited Brett Synicky to the podcast to talk to us about what they do at Sense Financial. Gosh, with all of the volatility in the stock market recently, we've received quite a number of inquiries from people who've said, I am not comfortable with all of my retirement invested in stocks, bonds, and mutual funds. The recent volatility has made me nervous, and I'm exploring other options for investing. So we wanted to bring on an expert in solo 401k and self-directed IRAs to help you understand how you can take back control of your retirement and invest in other assets like gold and silver bullion, like private lending, like commodities, and of course, real estate, actual real estate, not REITs. We joke that REITs are just stocks pretending to be real estate. Diversification is the name of so many people's game right now. So we wanted to give you more information so you can make the best decision possible for yourself. Sadly, so often folks are told that they can only be in the stock market or the bond market for their retirement, and your retirement is too important for you to not know about what your options are. So we're defying Wall Street. We're helping Main Street understand what their options are. And of course, the theme of the podcast, right? Abundant living. How are we living abundantly? Well, understanding that money is the vehicle to living life on our terms, doing what we want, when we want, where we want, with whom we want, for however long we want. It's important for us to understand this money vehicle. So here is another tool for your tool belt, and we'll see you on the other side of this episode. All the best, everyone.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. Get ready for empowering conversations, expert insights, and real-life stories that inspire you to live abundantly. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Sense Financial has been around since 2010. I had a solo 401k, which we will talk about, in 2014, hired a bunch of people, no longer was able to qualify for it, so I had to get rid of it and go back to the IRA structure. But in a couple of years ago, the owner of Sense Financial approached me and said, hey, do you want to come help me grow this thing? Do you want to become a consultant with me here at my company that I've been running for 15 years called Sense Financial, where we help people actually set up self-directed retirement accounts, as you alluded to, Amy. And that's literally all we do. We do two products, and we'll talk about them for sure. But it's a ton of fun. I love it. Personally, I have a couple young boys, 6th grade and 4th grade, and my wife, and we live here in Orange County, California, and they're my world for sure. And it's just great. So let's talk about what most people want to hear about, and that's how to invest in alternative assets using your retirement account.
I love it. Well, thank you for that great intro. As I said, we've known each other for several years. You know, what's great about having a working relationship like we do is when I'm asked, hey, who are other investors saying that they've had great experiences with, I'm happy to give, your name along with several others because you all treat folks so well. But again, going back to the original purpose of this is, let's call it the elephant in the room. There's been a lot of stock market volatility. It is making some folks nervous. And I don't want to speak for Brett, but I can say there's nothing wrong, obviously, with investing in the stock market. Where I like to scream from the rooftops is letting folks know that they have the option to invest in other assets as well in their retirement account, which is why Brett is here, which is gold and silver bullion. It is real estate like what I do. It could be private lending. It could be businesses. There are so many different choices, and we'll dive into that. But it is really about empowering folks to take control of their retirement. And so that's what we're here to help you all understand today. So, Brett, let's start off. Can you help us understand? You mentioned self-directed IRA, you mentioned solo 401k. Folks are probably familiar with a 401k from maybe their employer, maybe they're familiar with a traditional IRA or a Roth IRA. Can you help us understand kind of these different alphabet soup things for folks who aren't familiar with what they mean and how all of this fits together?
Sure. Yeah. Great question. Well, there are multiple different types of retirement accounts, right?
Mm,
There's individual retirement accounts, which is literally what IRA stands for. And any individual can go and open up an IRA.
mm.
Okay. It doesn't matter if it's self-directed or if it's just invested in Wall Street, right? It's still an IRA. Potentially anybody can open it up, right? Typically not a child, but you can have some minor IRAs, but that's a whole nother conversation.
Yeah.
And then you have the employer sponsored category, right? That's your 401k, your 403bs, your 457. Some of these are government sponsored. Some of them are just private employer sponsors, but those are the plans that most people are familiar with. And as you alluded to, what most people don't know is that in some situations, you are forced to invest in Wall Street, right? Maybe it's a certain list of funds that you can invest in. Maybe it's like these targeted funds and they go for 10 years and they're supposed to get you to a certain point with no guarantees, of course.
Mm.
And you choose from there, right? And it's employer sponsored, right? Your W-2 job allows you to have this plan, right? If you work at Walmart, they have a 401k option that you can participate in, okay? With Walmart, you're stuck at Walmart, right? You're stuck in their plan. Once you leave that employer, we like to call these orphaned or abandoned 401k plans because what happens oftentimes is people will leave that employer and go work somewhere else, but they don't do anything with that 401k that used to be sponsored by that company that they're no longer working for. Well, they can actually roll those funds over to another retirement account. It can be an IRA that they have at Fidelity or Vanguard or Schwab or wherever,
Mhm.
or they can roll it over into another 401k. Or they can roll it over into an IRA or a 401k if they qualify, and we can talk about that briefly, that can self-direct. They can themself, right? That's why it's called self-directed. They can choose where to invest with some guidelines, of course, and some rules to follow, which we can also touch on. But in a nutshell, that's the retirement accounts. They all act a little bit differently in terms of contribution amounts and limits per year, but essentially the rules are the same as far as Roth or pre-tax traditional. And just for those of people that don't completely understand what that means, is traditional is you're making a traditional contribution, reducing your taxable liability for that particular tax year. And then when you take the money out at distribution at retirement, that's earned income, that's taxable income. On the other side, with the Roth funds, you're paying taxes today, but the gains forever are tax-free when you take a distribution at retirement time. So an IRA can be Roth or traditional. A 401k can be Roth or traditional. It's just the type of funds they are. So yeah, hopefully that helps to paint a little bit of a picture about what they do and how they.
That's great. Well, and the bottom line is two takeaways I have is this choice, the increased amount of choice that folks can have. And then if I'm understanding correctly, correct me if I'm wrong, converting or investing in these types of self-directed or solo tools doesn't allow or doesn't mean that you have to take money out, incur a penalty, pay taxes when you roll, let's say, a former employer's 401k into one of these tools. Is that right?
That's right. That would be a tax neutral event
Yes.
and no penalties to do that. You're going from one retirement account to another.
Yes. Amazing. Amazing. So, can you outline a little bit more what assets? I mentioned a couple, but I'm sure you see all sorts of assets that folks invest in these products. Can you give our listeners some hints and ideas as to what's available to them?
Absolutely. That is the beauty of the self-directed retirement account, is that you can invest in what you know and what you understand, right? So it's easier to say what the IRS does not allow than it is to say what they do allow, because for as many people as there are on the earth, you could invest in some creative way, right? The only things you can't invest in are collectibles. So think baseball cards, stamps, cars, art, wine, that sort of thing, and life insurance in an IRA and S corporation stock, because you have to be a human to invest in S corporation stock. And then the other thing is, which an IRA is not, of course.
Yes.
And the other thing is there's certain disqualified parties like you and your immediate family as the IRA owner that you cannot invest in. So if you keep it arm's length and you stay away from collectibles, life insurance, and S corporation stock, you can literally do whatever you want. So when people ask me, what do I invest in? I want to do this, but what do I invest in? I say, first of all, we're not financial advisors,
Right.
and none of this is financial advice that we're talking about today. I just want this to be educational. If you need
Yes.
such advice, please seek out the proper professional. And our specialty is the establishment and kind of management of these plans, right? So when people ask me that question, what do I invest in? It's like, well, what do you know? Like, what are you
Yes.
comfortable with? Well, I know real estate. I've been investing in syndications. I've been an LP in different syndications for many years with my own personal funds. Well, hey, I recommend you probably consider doing the same thing with your retirement account. You know it, you understand it. You're probably not going to get burned because you know how to do the proper due diligence on the operator, et cetera, and the deal possibly. And you can do the same thing in your retirement account. And so it's easier to say what you can't invest in than what you can, but usually it's real estate in some way, shape, or form. It's buy and hold rentals, some short-term rentals, possibly. It's private lending is a big one. And then, of course, investing in private placement is also a big one as well.
I may have missed this, but for gold and silver, are you allowed to take personal possession or does it have to be with a third party?
Yes, no, you're not correct.
Okay.
With gold and silver, you actually need to invest. Well, first of all, you can only invest in gold, silver, platinum, and palladium,
Okay.
and they have to meet certain fineness requirements. And then a trust company, a financial institution, or a bank, as far as holding the physical metal, are the only places. You can't put it under your mattress or in your safe at home. And if it is a bank, the account, the safety deposit box, whatever it is, has to be opened in the name of the plan, right? In the name of the 401k or the name of the IRA. It's not you personally.
Interesting. Okay. So a few little nuances, but the great thing is you're able to help folks walk through that, understand what's available to them, maybe what's outside of IRS rules and regulations, but it doesn't seem like they're too overwhelming there.
I would agree with that.
If you all see me looking to my other screen, we're just looking at any questions that are coming in. So Brett, I'm curious, contribution limits, withdrawal rules, required minimum distributions. Are there any differences from these kind of self-directed and solo accounts versus kind of the traditional 401k and IRA folks may be familiar with?
Great question. One of my favorite topics because of the creativity you can have with these type of accounts. So first of all, the rules are the same, whether it's an IRA invested in the S&P 500 or an IRA invested in real estate. The rules are the same. You're still 59 and a half or older before you can take a distribution without penalties. And you are still required to take RMDs, required minimum distributions. Right now, the age is 73. That will probably change over the years because it ticks up as longevity continues to increase. But right now it's 73. So there's no RMDs, required minimum distributions, for Roth funds, by the way. So that's something to keep in mind. The more Roth, the more better, I like to say, even though that's not proper English, because those are tax-free ATM withdrawals when you retire, right? They are. It's amazing. If you could have a lot of money in your Roth account, you're going to have a great retirement. You can do the same thing in your traditional account, but when you take distributions, whether it's required or otherwise, you're going to incur taxes on that income, right? And so when it comes to RMDs in a traditional account only with alternative assets, it's important to plan for that. If you don't have enough cash in the account to satisfy an RMD, first of all, you can satisfy it from another account. So that's an option. Maybe it's an account at Fidelity or whatever with enough cash or liquidity to be able to turn stock into cash easily to satisfy that RMD. And by the way, seek out your CPA before you do any of this. But When it comes to owning physical assets or even illiquid assets like trust deeds or syndications or real estate, it's important to plan a couple, 3 years maybe ish before you get to that RMD age. So you either have to have enough cash in the plan to satisfy the RMD requirement, or which is basically a formula percentage of the total assets, right, per year, or you have to distribute an asset to yourself. And so you can actually distribute part of an asset, right? If I have a rental property in my plan, it's worth $100,000 and I need to distribute $25,000 to myself for an RMD, I can distribute 25% of that property to myself to satisfy that required minimum distribution for that year. Now, from an accounting perspective, it's a pain because 25% of that property this year is not the same dollar amount a year later because you have appreciation and all this other change in value. So you have to be really careful when you do this. But the easiest way, of course, is to just have enough cash in the plan to satisfy the RMD. So hopefully that paints a kind of clear picture on how those work inside the retirement account. But the rules are the same.
Okay, that's the bottom line. Well, I love again that you emphasize kind of this planning, this partnership, because winging it is not the best policy
That's right.
for this, right? It is retirement planning. It is strategy for a reason. So I appreciate you bringing that up as well.
Yes. Thank you.
Wonderful. Let's see. So I'm biased. I invest in real estate, but I also own gold and silver. I also have commodities. What would you say in terms of investing in real estate, all flavors, whether it's hands off with someone like myself that does real estate syndication or any other flavor that's out there? What are some best practices, if any, that you'd give to people who are interested in diversifying into real estate via a self-directed IRA or solo 401k?
Mm. Mm. Oh, best practices. Well, going back to what I said earlier, which I'll emphasize because I can add some value to it for sure, is people should invest in what they know and are comfortable with, right? And first of all, don't bet the farm on one deal, okay? You probably shouldn't roll over your entire life savings if it's in an IRA to a self-directed account and invest in one syndication deal. I'm just using that as an example. You probably shouldn't do that. Now, here's why. Well, it's about diversification, right? And it's about well, I'll leave it at that. Don't bet the farm. The other reason is when you invest in what you know, you're a lot less likely to experience the exhilarating feeling of riding a roller coaster when you lose your stomach and you go down this big hill or slope or whatever, right? You're a lot more likely to avoid that. Because when you invest in what you know, you can control it typically a lot more. Not completely, I understand that, but you have more control. You have access to the people who are running the actual investment. I don't know about you, but I can't talk to Elon Musk, even though I have money in the S&P 500. He will not take my call on how to run his company, right? Are you diversified with 500 different companies? Sure.
Yes.
But it's still stock market and you still have zero control over those companies. Most likely. Okay. With real estate, people are signing on the dotted line of what the terms are and what everything looks like. I realize that there's no guarantee. I'm not going to use that word, but it's a lot more sure of a thing than investing in Wall Street because of the control, because of the agreement between two humans and signing on the dotted line. Even if it's a rental property, the tenant is signing that they're going to pay on a certain day of the month, a certain dollar amount each month. Could they stop paying? Sure, anything could happen, but you evict them and you put a new tenant in. I know it's easier said than done. I understand that, but it's all about the control. And so that's the advice I would give is invest in what, don't bet the farm on one deal necessarily. And then furthermore, just when you're thinking about the difference between Wall Street and this, the control factor is not to be understated. And also, one more point on this, there's fees at Schwab, Fidelity, Vanguard. There's fees at these companies. Whether you see them or not, there are fees. And when you go to self-directing, if I get a payment from a syndication deal of $1,000, $1,000 is going back into my account, into my 401k or IRA. You might have a wire fee. It's like $20 or $30 incoming wire. Okay. But outside of that, there's no asset-based fees, right? With our company, because of the checkbook control aspect, there's no transaction fees, right? We have a
Right.
flat annual fee of $250, and
Wow.
that's our only ongoing fee.
Hmm.
And so if you self-direct for a decade or more and you do it wisely, you can quite realistically turn $100,000 into well over $1 million because of the lack of fees, the control, and everything else that comes along with those things that I mentioned. So.
I love that you mentioned the fees. I love that you mentioned, again, I know we've hit this drum several times in just the past couple minutes, but about that kind of investing in what you know, it really can't be overstated. And hey, again, we're not giving investment advice. We're not saying there's anything wrong with the stock market, but we just have had so many folks reach out and say, okay, I'm seeing it. There is volatility. I am betting my entire retirement on the stock market. And I'm a little nervous about the fact that I don't have some of these other asset classes that might benefit me. So we're just excited to be able to give you the step by step here. But Brett, I did want to mention and talk a little bit about neither of us are CPAs or tax professionals, but are you able to talk a little bit about UDFI or UBIT, investing in real estate, and kind of
Sure.
what that might look like in a solo 401k versus a self-directed IRA, and some nuance there as well?
Oh, yes. The rabbit hole of
Yeah.
UBIT and UDFI. Let's do it.
Okay.
Okay, we'll keep this high level because it
Yes.
could go on.
Thank you.
So, first of all, acronym definition UDFI, unrelated debt finance income, is only a thing in the IRA, not the 401k. I'll clarify that in a moment. And then UBIT or UBIT or UBTI is unrelated business income tax, okay?
Right.
Which both the IRA and the 401k can have. Let's focus on UDFI first because it's more applicable to the real estate conversation. First of all, the plans are designed to be invested passively, right? Actually, let me save that point because that's more of the UBIT conversation.
Okay.
When you invest in, let's just use real estate as the example. When you invest in real estate and there's leverage, meaning there's like a mortgage or a bank loan of some sort, or even a seller carryback or some other creative type of financing, right? When there's leverage, the leveraged portion of the income is going to be subject to this UBIT tax. See, the IRS, this is one of the other points of stock market versus real estate.
Mm.
The IRS allows you to get a loan to buy more real estate that you wouldn't otherwise be able to do.
Yes.
And so, but there's a little bit of a penalty to that in the IRA only, not the 401k.
Mm.
And so when it comes to this, you're not using all your money. The IRS allows you to do it, but they incur a tax on the income. So let's simple math. Let's say there's 50% financing on a property. So 50% of your IRA put 50% down and got 50% financing. Okay. So 50%, the same percentage pro rata, the same percentage of the mortgage that matches the income, or the same percentage of the income that matches the mortgage. So 50% of the income is subject to this UDFI tax. Okay, it sounds ugly, but it's not as bad as it sounds. It scales up to 37% when you get to around $16,000 of income for the year.
Mhm.
However, out of that percentage, that 50%, you still get to actually take depreciation and you still get to write off expenses. And so let's take a syndication deal, for example, especially when you factor in the cost segregation that's going to occur. You're probably not going to show any gains for at least the first couple, maybe even 3 years.
Mm.
Again, check with your CPA, talk to the operator of the syndication deal about what the income is going to look like in the cost seg and all that stuff. But generally speaking, when you factor in the depreciation, especially when it's accelerated through cost segregation, and also the expenses for the first couple, 3 years, you're not going to have to worry about any UDFI tax because there's not going to be any income to show. Doesn't mean you're not getting deposits, by the way, and Amy can clarify that, but it's just when it comes to the income, it may not actually be there. And so that's UDFI. Now, everything I just talked about, if you have a solo 401k, which is the self-directed individual 401k plan, it's exempt from that, right? So if you're self-employed, the solo 401k is the better way to go if you can qualify for it and you don't have any full-time W-2 employees when you're going to invest in real estate with a mortgage, okay? It doesn't mean don't do it with an IRA, but it's just something to be aware of in the IRA.
Love that. Okay, this is really easy to understand. Thank you for that, Brett.
Yes,
So
hopefully I didn't make it muddy.
I don't think so. And if you've got questions and you're watching this live, please definitely put that in the chat. We'll be monitoring that. But it's interesting you mentioned, because I've heard several people say, why would you invest in real estate in your qualified funds? You're missing out on this depreciation aspect of real estate. That's a whole other thing that we can talk about. But it sounds like from what you're saying, when it comes to some of these UDFI, UBIT type things, that the depreciation can be used to offset some of that income that could be taxable. Am I hearing that right?
That's right. Yeah. Well,
Okay.
the same percentage that matches the amount of financing you get.
Yes. Okay. All right. Very good. Well, that's useful to know. That was new to me. But as you said, the solo 401k is completely exempt from this. This is only an IRA.
That's right.
Okay. So that might be an advantage for folks who are toggling and considering which one might fit them both, or what might fit them if they're looking at real estate where they're using leverage.
Right. Exactly.
Okay. Wonderful. Well, I'm just going to take a pause here to see if there are any questions that have been coming through. Nothing yet. But y'all, one of the advantages of being live is we get to ask Brett questions. So please don't shy away. I'll continue to pepper him with questions. How's that? Okay, fantastic. Well, that was really helpful. So let's just say, let's use a case. You and I have actually been working together with quite a number of people who are interested in investing in a deal that I have in their retirement account by rolling over to Sense Financial's either solo 401k or self-directed IRA. For those who are curious, hey, what are the steps? What does this look like? Do you mind giving kind of a high level of, this is typically what happens, this is the time period, just any details so folks can get a little familiar on what the process might look like?
Sure. Yeah. And of course, the process is different for the IRA versus the 401k.
Sure.
So let's cover the IRA first.
Okay, great.
So our business is a niche within a niche. That's what I call it. So the niche is self-directed retirement accounts. The niche within that niche is checkbook control. So
that's
there
okay.
Might
have been a little thing there. Go ahead, please.
Yeah, that's okay. I thought you were saying something, but your mouth wasn't moving, so it was somebody else. That's all right. So with checkbook control, basically you do not have to go through the custodian for transactions. Okay. So there's a basic IRA. I'm going to keep this as high level as I can. There's a basic type of retirement account where there's a custodian. Think Vanguard, Fidelity, T. Rowe Price, Schwab. Those are examples of custodians. They only allow you to invest. It's the custodian that restricts what you can invest in, by the way, not the IRS. We already covered that. So if you have a plan with one of those providers that I just mentioned, you're going to be restricted to what they offer, primarily stocks, bonds, mutual funds, and maybe ETFs. Most of them are doing ETFs now as well. And so again, nothing wrong with that. However, if you want to invest in alternative assets like we've been talking about, you have to move your money to another custodian that allows for everything that the IRS allows for, which is obviously everything except collectibles and the stuff we talked about. So you have to go from a Schwab to another custodian. Now, with an IRA, you have to have a custodian. Okay, we cannot eliminate the custodian with an IRA, but we can bypass the custodian. If you don't do this, and there's two different ways of setting up a self-directed retirement account. One where you go through the custodian for everything, meaning you have to complete usually an online portal type request. They have to sign everything for benefit of your IRA or 401k. They have to wire the funds. They have to do everything just at your direction. It's not a second set of eyes to vet a deal. That's not what they do. Don't think about it like that. They literally are just there because the IRS says they have to be there. And quite honestly, it's a business model. They're usually charging you transaction fees and per asset fees, et cetera, each time you do something, or annually, depending on the fee schedule. Okay, we don't do that type of account. We set up what's called checkbook control, where you don't have to go through them, like I just mentioned, for performing transactions, investments, everything else. With checkbook control, we set up a special purpose LLC that the IRA owns, that you are the manager of. You're a non-member manager of this LLC. It's a special operating agreement. It's not like your regular LLC that you use as a holding company for your real estate or run your business through. It's totally different. Okay. And as the manager of the LLC, which is where all the assets from the IRA are actually held, see, IRA owns the LLC, assets are in the LLC, you're the manager of, so you have check writing authority. You can sign on the dotted line. You can wire money from the checking account to wherever for an investment. Okay. That's checkbook control, way more control. It's a lot easier to do. No transaction fees. Like I said, it's just that flat 250 annual and that's it. And then we bypass the custodian in an IRA. Okay. Now with a 401k, there is no custodian requirement. So we eliminate the custodian because it's not required. So the 401k is a trust. So is the IRA for that matter. But the 401k is a trust document. That's the type of document it is, structure. And so you are the trustee of the solo 401k at the 401k level. There's no need to create another special purpose document, LLC, to have checkbook control. You can just have it at the 401k level for controlling all the assets, writing checks, wiring money, making decisions. You're the fiduciary. Your responsibility is to steward the account in a way that is in the best interest of the account, which you're the benefactor of down the road, but right now it's not your money. And so that checkbook control comes with responsibility, but it comes with power as well. And it's just easier to maintain and manage the account when you do have the checkbook control. So does that all make sense?
Yeah, I'm really glad that you mentioned the checkbook control, because that's quite a difference that we see, at least on our end, when folks invest alongside of us. Those that have that checkbook control, it seems to be a very different process. I'm not going to put a qualifier on it in terms of better or worse, but it is a distinction that I think is important for folks to understand the differences and why it may or may not fit what they're looking for. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show.
By the way, when doing consultations, we will find out what their goals are, right? If they're going to do one transaction, I had a guy the other day, he wanted to invest in a startup and he was going to take like 50 grand and invest in the startup. And that was literally the only transaction he was going to do for like the next 5 years. I'm like, okay, I'm happy to help you. And so if there's a disadvantage to the checkbook control, it's a higher setup fee, but way less over time, right? Even break even is like the first 3 years. It doesn't take a long time.
Right.
But this guy's going to do one transaction for like the next 5 years or beyond. I'm like, dude, you don't necessarily need checkbook control for that. Like it's okay to possibly go through a custodian, cost you less to set up. And you're not going to do a bunch of transactions every year. So you don't necessarily need the checkbook control. So I just want to paint a picture, and definitely nothing against that checkbook control aspect.
Right.
It's just, if you're going to do a lot of transactions, it's easier to have the full control, obviously. So, yeah.
That's perfect. Well, and that underlines the point of tailoring to folks' goals and you having that suite of knowledge and experience to really understand and do the consultation to help match folks with the best product attributes that really helps what they're looking to do.
Yeah, definitely. Can we talk about the contribution amounts?
Let's do it. Thank you for bringing that up.
Yeah, for sure, because it's important. First of all, if you are self-employed, legitimate self-employment activity, not passive rental, Schedule E income or otherwise, you're working and you're self-employed and you're earning money, or you're attempting to earn money, right? You're self-employed, okay? If you don't have any full-time W-2 employees, you should consider a solo 401k. If you don't fit that category, you can become self-employed, that's a whole nother conversation, but don't try and fit a square into a round hole. Like, let's just focus on the IRA instead. Okay. So I want to make that distinction. Anybody can do an IRA. Self-employed, no full-time employees can do the 401k. All right. That said, the solo 401k has contribution limits literally 10 times the amount of an IRA. So if you're under 50, an IRA is $7,000 for 2025. If you are under 50 for a solo 401k, it's $70,000 for a solo 401k. Now that the contributions have to come from the business income. Okay. I'm not going to dig into what that looks like because it's beyond the scope of this conversation, but just know that the contribution amounts are 10 times higher. If you're over 50, 8,000 for an IRA or 77,500 for a solo 401k. So those are just a couple of reasons why the solo 401k, along with the no UDFI, can be a superior product to the IRA. So I just wanted to clarify what the contribution amounts look like per year.
Huge. No, that's a very significant difference. So I appreciate you bringing that up because that can make a difference for some folks. Again, it sounds like that there are qualification criteria and we don't want to, I love that you said, put a square peg in a round hole or vice versa, making sure that we understand what the qualifications are, what the criteria are, but that's quite a difference there.
Mm-hmm.
Kay had a great question. Hey, Kay. Kay's always asking amazing questions. She's wondering if it's possible to invest in one asset class deal as a limited partner with both personal funds and self-directed IRA funds in the same deal to meet the minimum investment, such as $50K.
Oh, what a good question.
I told you, she's really smart. She asked a really great question. So I have my answer, but Brett, I'm going to have you answer from your perspective, if you
Sure.
would.
Yeah, well, I know the IRS and Department of Labor rules to this, so that's what I'll say.
Great.
You cannot enable your IRA, and your IRA cannot enable you. What does that mean? Well, it means that either party, your IRA, 401k, or you, need to be able to make that investment without the other's help. Okay. So you might ask yourself, why then would I even involve myself if my IRA could make it without me helping out with some of my personal funds? Well, I don't know that you would. That's the point. So that's the Department of Labor rules. You don't want to commit a prohibited transaction by enabling the other. Okay. Now, if you can work it out with an operator to allow for a lesser amount to get in, a lesser minimum, now you can make one investment for $25K with your personal money, and you can make one investment for $25K with your IRA money. That is the cleanest way to do it. Partnering up with your retirement account is not necessarily the greatest idea because it increases the chances of committing a prohibited transaction or being accused of it and having to prove otherwise. Okay. Which in an IRA can, if they find that you did, can disqualify the entire plan. Okay. And that means it's a distribution and there's taxes and penalties if you're under 50, 9.5.
No, thank you.
So that's my answer. There's some more nuance to it, but I'll leave it at that for now.
That's wonderful. That's great. Yeah. On our end, just for how we do business, that is too complicated for us, rules and regulations aside. So yeah, if it is a $50K minimum, we need at least from your unqualified funds or from your qualified funds for it to meet that minimum. We can't combine those two. It sounds like the IRS doesn't allow that anyway, but we can't combine those to reach our minimums either. So it sounds like, but to your point, if you meet one of the minimums alone and want to use two different vehicles to reach those minimums separately, then that could work on our end as well.
That's right. Yeah.
Great question, Kay.
And again, Kay and anybody else, that's a question where a more one-on-one conversation would need to take place because there's other kind of creative options that I'm not going to cover in this call.
Good. Yeah. Well, I like that. Gosh, time is going by so quickly. Is there any kind of final advice or information before we share how to get in touch with you that you give to folks that are starting on this journey, that are trying to understand how they can take back control of their retirement accounts, Brett?
Yeah, here's my advice. It's kind of like real estate. Don't wait to buy real estate and wait. Okay. And here's why I'm saying that, especially in light of what's happened lately in the stock market. First of all, if you look at the 2022 kind of chaoticness that we had, if that's even the right word, we're way up from that. Even with the recent kind of drop, we're still way over where we were in like 2022, 2021, somewhere around there. Okay. Again, I'm not a financial advisor. I'm just looking at the graph, right? It's pretty
Yeah.
obvious. Okay, so look at the whole picture. Don't just look at the last 2 weeks or a month. That would be advice number one. Advice number two would be, I can't tell you how many people I talked to like a month ago, 2 months ago, 3 months ago that were in the I want to think about it phase. And they have come back to me now and they've said, man, I really wish I would have set that up with you 2 months ago because I could have rolled out some of these funds when they were worth more per share when I liquidated, right? Because you have to liquidate, you have to turn it into cash to be able to transfer it to another plan.
Yes.
So you sell the stock. And now they're like, they don't want to do it because the stock market's down. Well, when does it go back up? I don't know. They don't know. Nobody has a crystal ball. So do they wait until it goes back up? Maybe. How long is that going to be? Or do they just bite the bullet now, self-direct? So I'm not telling people what to do, but
Nope.
if I were in their shoes, I would buy real estate and wait, is what I'm trying to say. So
I appreciate that. Yeah, this is a process. Rolling over your retirement accounts to someone like Brett will takes time. It's not an instant thing. So getting that process going. And to your point, this kind of need to time the market can be quite difficult. I don't know many people who can do it all that well. So to your point, I have talked to a couple of folks who said, well, gosh, my favorite stock is down 20% and I'm going to wait until it comes back up where I break even in order to get this ball rolling. And my reply is not advice, but you realize it's going to take 25% increase to get back to where you are. And I don't know how long that's going to take. It may be a good move. It may not. It really depends, but it is quite challenging to time anything, any asset class, not just stocks, bonds, and mutual funds.
and the point of the whole thing is control.
Mm-hmm.
Well, way more control
Hmm.
versus little to none, right? And that's the difference. So
Yeah, well said. We've got one final question from Kay. If
awesome.
you've got a minute.
Yeah, of
She
course.
wants to know if she's lending through her self-directed IRA, are you being charged for incoming ACH fees to accept monthly payments?
ACH is free, by the way. And
Okay.
that's usually with most banks, ACH is free. So if you can set up ACH, go for it. But like any financial institution, there's some wiring fees, outgoing and incoming, to be aware of. They're between $20 and $30 per wire. That's a banking fee, by the way. That's not us. We're not a bank. We don't hold any of your money. We just create the plan and help you set everything up.
Okay,
So that's something to factor in for sure.
great. Thanks for the question, Kay.
Yes, thank you.
Well, Brett, for those who want to get in touch with you, what's the best way for them to get a hold of you?
Honestly, our website, sensefinancial.com, not like dollars and cents, like common sense, SENSE, right? Financial.com. And I say that because like I'd love to have people call me or email me directly, no problem at all. But that's all over the website. You can schedule a consultation, but there's all sorts of education on there. There's a drop-down menu for solo 401k, a drop-down menu for checkbook IRA, and you can learn all about them and the different options underneath those. So that would be my recommendation as to where to start.
Fantastic. And I say this every time, but y'all, I get no benefit whatsoever from Brett or from Sense for bringing him on, for giving him exposure, talking about the great feedback that I received. I just say that because I think it's incredibly important for y'all to understand conflicts of interest in relationships. I've just heard great things from my investors that I care deeply about the company and how they've treated folks. So just want to make that known there. So Brett, we'll make sure to put that website all over on LinkedIn and YouTube and all the places where we're streaming. This will be a podcast episode as well. And folks, if you're looking to get in touch with us at Sylvis Capital to get to know us a bit more and maybe explore investing in hands-off real estate, we can be reached at sylviscapital.com as well. It's a funky spelling of my last name. So we put that link in the comments as well to make it easier for you all. Brett, thank you so much for joining us today. I so appreciate how much you help people and you make a difference. Retirement planning is no joke. It takes a lot of strategy and, of course, trusted partners like you and Sense Financial. So we really appreciate you joining us today.
Thank you so much for the opportunity.
All right, everyone. Thanks for joining us, and we'll talk to you soon. Bye for now.
Bye-bye.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.